Morning, everybody. My name's Sean Cartwright. I'm in business development with AG Stockbroking and AG Financial. We've been fortunate enough recently to partner with Gary Davis, who is an expert in his field, and he's been kind enough to offer his time this evening to present this webinar for our clients. Gary's got about 30 years experience, and yeah, I'll hand you over to him. Thank you, Gary.
Okay, thanks very much, Sean. Welcome everyone to this webinar. I guess it's pretty timely because in the last few days there's been some very substantial moves around the world. So I think it's times like this it's really important to get a sharp perspective on A, how to protect your capital, and secondly, how you can take advantage of these opportunities, because the reality is that increased volatility gives you more opportunities, but it also makes it a little bit harder to deal with if you don't have a really well-developed trading or investing plan to go with it. Now, just before I start, I operate under the license of Avestra Capital. What I'm going to go through tonight is general advice only. I obviously don't know anything about anyone's personal circumstances, so just bear that in mind as I go through. But this is the distillation of all of my learning, all of my kicks in the tail over 30 years. It's the most succinct information that I can give you about how to do well in the stock market. Now, the purpose of tonight is that it's information about how to go about things in a pretty effective way, and a lot of learning so that you can make better decisions in the market in the future. That's the purpose of tonight. It's to give you information to make better decisions. Now, whether you choose to go routes A, B, C, or D will depend on you, but that is the purpose of tonight. Now, I've got a huge amount of information to get through, so let's get cracking. The agenda is, oh, by the way, there'll be questions, time for questions at the end. You're free to pose questions at any time as we go through, but I won't be actually addressing the questions until the end of the webinar. So the agenda tonight: how to find the best local and global opportunities, the most reliable trade setups, how to buy at the right time, and as I said, with the volatility we've seen in the last couple of days, which has been pretty extreme, then this sort of trade setup, really comes into its own. Importantly also is how to avoid big corrections, and a lot of people are asking, is this the start of a big correction? So again, I think the timing of this webinar tonight is absolutely spot on. Now, also I'll be looking at a couple of stocks that are poised to take off. Now, this PowerPoint presentation was actually developed about a week ago, prior to all of the major moves through the week. So the processes I'll be talking to tonight are absolutely valid. Nothing. When you get a sudden burst of volatility like this, then some of the entry prices you need to be a bit more conservative on. So what I want to go through first is the process that I use for finding the very best opportunities. Now, this is I use fundamentals, I use valuation, and I use technical charting techniques to do that. I'm not going to go through this in a great deal of detail because that's not the purpose of tonight, and for anyone that wants more detail on this, there is quite a great deal of that in the blog on our website, which is specialistshareeducation.com.au. So I'm just going to go through this very, very quickly because there are other, I think, more important issues to talk about tonight. So the process that I use to go through identifying what are fundamentally really strong companies, I'm looking for strong and consistent return on equity, and that's just such an important number. I'm looking for earnings per share growth at a certain rate, and also reliability. So I'm looking for earnings per share growth in excess of 15% a year, but not only am I looking for that as a longer term average, but I also want to see it being pretty repeatable. You don't want earnings per share growth rate that's diving around all over the place. You want to be able to have a reasonable degree of confidence about what's coming over the next 2 to 3 years. Similarly with dividend growth, I'm looking for dividend growth of certainly above average levels, 10 to 15% a year growth rate, but also the dividends, the stocks that have got dividends that are likely to be reliable into the future. That's a little bit about the sectors you choose as well. Next, the generation of free cash flow is critical. There's been plenty of profitable businesses that have gone bankrupt because they actually ran out of cash. They were from an accounting point of view, they were profitable, but they just couldn't get the cash in quick enough. So I tend to look at free cash flow, which is the amount of cash left over after the business has not only paid all its expenses, but also reinvested in itself as well. So that's the cash left over after everything. Debt's obviously important, and I use the term manageable debt because it depends very much on the sector and the requirements of the company. Some companies can operate very happily with higher levels of debt, so I don't operate to a particular level or a particular percentage of debt as some people do. They have certain hurdles. As you'll see as I go through tonight, any financial number has to be taken in context. It's just an absolute fool's paradise to take a number in isolation and think that you can apply it across the board. It just doesn't work that way, I'm afraid. I also look at something called the PEG ratio, or I don't actually do it this way, but it's the simplest way for me to explain it to you. If you had a stock that was trading on a PE of 10 times earnings, and it was growing those earnings at 15 times, 15% per annum over the long term, then that gives you a PEG ratio of less than 1, which is attractive. So it's just a very broad brush way of determining valuation. The second thing that I do, so we look at fundamentals first, the second thing that I do is look at value. And I base that value by looking out 3 to 5 years, looking at making assumptions and educated assumptions from a great deal of research on where I think the earnings per share is going over the next 3 to 5 years. And also make some assumptions based on dividend growth. Now again, there's no way that you can make rational assumptions by just looking at a set of numbers. You have to have an awareness of what's going on around the world. You have to have an awareness of where those sectors are going. This is the sort of research that requires you to be pretty much fully immersed in the market to do this effectively. If you're doing this on a very ad hoc part-time basis, then yes, you can come up with a number, but will you actually understand what that number means? I'd suggest that it's pretty tough to do so. So fundamental merit 1, valuation second, then you need to look at future performance. The past performance is all well and good, but is that going to continue in the future? And again, I refer to the comments I just made about you've really got to be immersed in this research constantly because it's a dynamic situation to know whether future performance is likely to continue. And so important that all the numbers that you come up with have to be considered in the bigger context. And I'm going to talk about more of that in the next couple of slides. Next, we go to technical chart patterns. So those first 3 things, the fundamentals, the value, and the future performance are all what I call a pre-filter. Once I've done that, that gives me a short list of stocks that are robust and are value. I then move to technical chart patterns, which from my perspective is the essential element. There are lots of people who work solely with fundamentals, and fundamentals are fine and have validity over the long term. But fundamentals can be virtually meaningless in terms of the price over short to medium terms. So to me, if you're not taking account of technical chart patterns, then you're trying to play this game with one hand tied behind your back and both feet tied together as well. It's just not using the tools that are available. So before you look at any stock, you need to do a couple of things. First thing is you need to assess the global sentiment and the index patterns. And over the weekend, for anyone that does tap into the weekly videos that I did, I spent over the last 2 weekends, in fact, I've spent quite a bit of time looking at the indices, and we'll have another look at that tonight, to determine what's happening globally. Now, it's absolutely vital, and hardly anyone does it. You know, people tend to zero in on an individual stock and then just look at it from a stock-specific basis without actually thinking about what's actually going on globally. And just in the last few days, we've seen some of Australia's really good stocks. Some of them are a bit overvalued, but I'm referring to stocks like REA Group, Ramsay Healthcare, carsales.com, Seek, those sort of companies, which have got very robust businesses. Now, they've all had their share price substantially reduced in the last few days because there's some global stuff going on, mainly out of Europe, that is just frightening the pants off everybody. And so unless you're taking account of global sentiment and adjusting what you're doing with your trading and investing, then the fundamental answers you're coming up with may not necessarily be worth a real lot. So great stocks can still get beaten up if sentiment turns. Now, we've seen a very, very sharp downturn in markets over the last 2 days. Just before I came on air, the global futures were rebounding a bit, which is pretty normal. But in some areas, there is no question that the trend has now broken down and that the bull market's finished, and we're into a new pattern. Just a quick few thoughts on the American economy. On the global context, I beg your pardon. Now, from my perspective, the American economy is by far the best economy in the world. It's being underpinned by the energy boom and the digital technology revolution that they've also got going on in America. And if it's one thing that Americans are very good at, it's innovation. Now, those two things, and in particular the energy boom, which has reduced the cost of energy in America to a substantial degree, has led to a manufacturing renaissance. A lot of manufacturing left America during the 80s and 90s, and it's come flooding back in the last couple of years. It's been an amazing turnaround. So that has made a huge difference to America and their competitiveness. Corporate America is in better shape, particularly in the selected areas that I look at, and and again, please let me make this point. When I say America and corporate America is doing well, I'm not talking about the entire economy or the entire market. I am very targeted and very focused on the sectors that I believe have undeniable growth baked in for the next few years. So they're the sectors I'm talking about. So they're in better shape than I've seen for a long, long time. Moving on to Europe and Japan, there are huge question marks. And as I said, I prepared this PowerPoint presentation a week ago. Since then, the ECB has come out and basically stunned everyone by saying, look, what the measures that we've taken really aren't working. And in another way of putting it, we're not really quite sure what to do. And that's really, there was a number of factors that led to this big sell-off on Thursday and Friday. That is the root cause. I think people were really put off by the ECB saying what we're doing is not working, and that's been a large part of what's driven what's happened in the last few days. Now, China, they're going to have some speed bumps as well. No question, you can't transition an economy from doing one sort of thing, which is focused on exports, to doing another sort of thing, which is focused on the consumer, without some speed bumps. So, no question. But I read extensively on China, and from what I've seen, China's doing okay. They're handling this as well as can be expected. And there's always people out there that are trying to poke holes in the China story, but you want to believe that this is going to go on and be a major driver of global growth for decades to come. So just try and look past some of the short-term hiccups that are going to occur when economies are transitioning. Now, moving to Australia, we have some absolutely severe economic headwinds. We are totally unprepared for the size and the speed of the changes that are rushing through our economy at the moment. And I think, if you look at the information with an open mind, I think you'd have to agree that was the case. We are globally uncompetitive. Our wages costs are too high, our cost of living is too high, we are just globally uncompetitive. We are massively reliant on China, and the worst thing is that we don't control what happens there. So it's a very shaky position to be in when you're massively reliant on something that you can't actually control in any shape or form. So I think we've got some very severe economic headwinds, and that means that most of our stock market is at some degree of question mark or risk. So my overall conclusion, just to put all this in context, is that US stocks are far better value and the trends there are far more reliable. And again, I just reiterate, that's in certain selected sectors only. I look through hundreds of charts in both markets several times a day, and the difference is quite stark between the two. So my strong suggestion would be that the majority portion of your funds really should be offshore. Now, I know for most people that's a really difficult concept to get your head around, but hopefully by the end of this presentation tonight, I would have influenced you to think a little differently about how you go about your trading and investing. Now, looking at the local stocks in Australia, true value is really hard to find. Now, there is some value here. There are some great businesses here. So, I'm not anti-Australian stocks by any stretch of the imagination. I'm just realistic about what's going on. And to me, the only stocks that I am really interested in the Australian market, given all the severe headwinds that I spoke about previously, are stocks that have got global expansion potential and reality. They're the stocks that are going to be able to grow their businesses because they're out there on the global stage. A lot of stocks that are just focused on Australia are they're going to find it hard work to grow their business. So significant care is needed in Australia on, first of all, your overall exposure. I think at the moment you should be significantly cashed up. Certainly significant care with your sector exposure is absolutely critical. There's some sectors that you just don't want to be a part of at the moment. And also you need to be very, very careful about your entry prices because trends are less reliable. Now, that's been the case for the last 2 years. This is not an event driven by the last 2 days. This has been the situation for the last 2 years, that Australian trends are less reliable than what you can access overseas. So that means that you just need to demand a better entry price. Now, what I'm going to do is to go through, give you some substance. I'm going to go through a case study. I'm going to look at a number of other stock charts tonight, and try and give you as much value as I can. So, just from an overall point of view, I'd just like you to think about this. You need to go where the momentum is. There's no point in trying to flog a dead horse and stay purely in Australia in the stocks that you always invest in if they're not going up, and even worse if they're going down. So what I would encourage you to do is that every time you want to put some new money into the market, that you look around the world and ask yourself, where is the best reward that I can get for that money, that valuable capital of mine? And don't just do what you normally do. So the process is pre-filter with fundamentals and with value, as I spoke about earlier, and then we look at the charting setup. So with those thoughts, let me go through an example. This is a pharmaceutical, a very large American pharmaceutical company called Gilead Sciences, and they really underscore what it is I've been saying about about the value and also the price trends. Now, just quickly, their business model is they're a biopharmaceutical manufacturer for life-threatening diseases. They have a market capitalisation of $140 billion. Now, I would like to bet that 95% of the people on this webinar have never heard of them. but they are of a market size of the dimension of Commonwealth Bank, BHP, probably larger than Telstra. So they are a significant player in the global pharmaceutical area. Their profit margin is a very healthy 43%. Return on equity is a stunning 54%. Now, to put that in perspective, if you've not encountered the term return on equity, to put that in perspective, that's like you putting your money in the bank and the bank paying you a 54% return, because that's in effect what this company and other companies like it are doing when they generate that sort of return on equity. For every dollar of your money that you effectively give them by buying their shares, they're generating 54 cents worth of profit. And I don't know too many people that can generate that sort of return. So if you give your money to a company like this over the longer term, then they're going to produce you a very, very fancy return. They have $9.5 billion in cash. They have $8.5 billion in debt, so there's net $1 billion on the balance sheet. They've been growing their earnings per share over the last 5 years at an average of 20% per year, and that's a pretty good effort for a company that's already $140 billion market cap. The forecast for the next year is 20% and a bit better, and given the drug pipeline that they have, I have absolutely no problem with that forecast, and I just don't blindly accept analysts' forecasts. I look at it, I ask myself whether it makes sense, whether I think it's achievable, looking at the sector and looking at the business itself, and I'm very comfortable that that's a very achievable number. Now, whether it actually gets achieved or not is a dynamic situation. So I never lock anything in as a given, but I'm quite comfortable at this stage to value this company on the basis that that can be achieved, because I think it's realistic. Now, for all that performance, that amazing financial performance, you're only being asked at the moment to pay 12 times earnings, which is extremely cheap. The company over the last 5 years has traded in a PE multiple band between 10 times and 27 times. So when the market gets really excited about it, it trades up in the 20s, and towards the bottom it's in the 10s. You can see at the moment that it's trading towards the very lower band, the very lower end of its band. So it's certainly potentially got plenty of upside, not only through the growth in the profit, but also through the growth in the PE multiple itself, and that can just do amazing things for the share price. The second quarter results, we should get the third quarter results very soon, but the second quarter results easily beat expectations from analysts and rose 372% on the previous Q2 results from 2013. So that was a massive, massive beat. A very significant 27% upwards revision in earnings per share forecast by analysts occurred in the 90 days preceding those Q2 results. So the situation is that analysts are actually scrambling to upgrade their forecast quickly enough to keep up with the progress of the company. So all very positive things. Let's have a look at the technical setup, but also the risks. You should always look at the risks. I guess with pharmaceutical companies, the risk is that a competitor brings out something better that does it, faster, quicker, cheaper, and that's always the case. But with a company the size of Gilead, with a pipeline as broad and deep as they have, I think that goes a long way to offsetting that sort of competitive threat. So, I think the risks are relatively low. Let's have a look at the chart and put some substance to what's been going on with Gilead Sciences. So let me pan back and just show you what this share price has done as a consequence of that fantastic financial performance. Now, if we go back to February 2012, so we're talking around about 2.5 years, when the run really started, and it was trading about $23, $24 at the time, and it's gone on a extremely powerful uptrend, and the price has gone up by more than 400% to about $110 at the peak. So that's been a stunning performance, and yet despite a 400% increase in price, you can see the stock is not overvalued. That's because the earnings have just been growing at such a rate that it's the price rise has been well and truly justified. So this is not a Facebook or a Twitter or a LinkedIn where the share price has just gone nuts because people forgot about fundamentals and about value and just went stupid. This is based on good, solid fundamentals. Now I'll ask you before I narrow in, just to observe two things. Firstly, we had a sharp pullback in March that lasted about 3 or 4 weeks, and that was really sector-wide. All the biopharmaceutical companies pulled back sharply in price because of a couple of very short-term fears, which obviously, in the light of subsequent events, were proven to be pretty much a non-event because the price immediately turned around and went from 65 up to 110. So that's the first thing. The second thing I'd like you to note is that despite the huge upheaval in global markets over the last 2 days, look at the share price. It's hardly moved. It's gone down 1 or 2%. This has been one of the better performers on the US market, and that's the consequence of buying the stocks according to the pre-filtering techniques that I went through earlier. Now I'll come back to the analysis of this shortly, but they're the points that I wanted to make at this stage. Now, in recommending or in covering this stock as a high conviction stock of mine, I'm not necessarily saying that paying $105 is necessarily the price you should pay at the moment. So wait, and there'll be a bit more information on that. Now, so looking at comparative value overall, in America, there are hundreds of high-quality stocks that are in powerful uptrends that I've identified. These are companies that have got forward forecast earnings per share growth of above 20%, and I believe that they're all realistic. They tend to be in very defined, very select sectors, but I believe those sort of growth rates are sustainable. They have PE ratios between 10 and 16 times, which for those sort of growth rates is attractive. There's just no question about it. Now, turning to Australia, and again, I'm not Australia bashing here, so please don't misinterpret my meaning, but it is almost impossible to find such a scenario of growth and guaranteed is too strong a word, but high probability growth above 20% per annum and being able to get it at good value. We've got some great global businesses. REA Group is a terrific business, but it's trading at 29 times earnings. Ramsay Healthcare is a terrific global healthcare business. They've got a fabulous business model that works really well, and they're rolling it out to the world, but they're trading at 30 times earnings. Seek, same comments, 28 times earnings. CSL, fabulous business in the blood plasma area, 22 times earnings. Domino's Pizza, a great business. If you haven't looked at Domino's Pizza, it's a business you should look at. But my word, 42 times earnings. It's not the point to be buying it at. So it's almost impossible to find the American scenario in Australia in terms of quality, growth rate, and value. That's the important thing. And as I said earlier, the difference in price trends between the two markets is absolutely stark. You're pretty hard pressed to find a Gilead Sciences kind of price chart in Australia at the moment. A lot of them are going sideways, and many of them are breaking down. Now, the next thing that I want to cover is the setup, which was conveyed to you in the email, that I was going to go through a setup which I believe is one of the most reliable setups that you could monitor. It's simple. I think you'll be surprised by its simplicity, but it's definitely not easy to do, and I'm going to go through why it's not easy to do throughout the rest of the webinar, because it's important to understand that just because something is simple, it's not necessarily a simple thing to execute. Just bear with me one second. Sorry, I'm back. Okay, so this is the way that it works, and it does require a pre-filter based on fundamentals. So this is not the sort of setup that you just go and apply anywhere at any time to any stock. So it requires a pre-filter based on fundamentals. It also requires a very clear appreciation of where markets are in the global cycle. So it requires the making of a global call. And people that work with me and members of our organisation know that I make global calls all the time and before we make other decisions. And again, it's this process of putting any piece of information that you get into a proper context. And unless you know what's going on globally and how markets are likely to respond to that globally, then you could be making all sorts of significant errors in terms of your trading and investing. And thirdly, it requires discipline in execution, and this is where it breaks down for most people. It's in the execution phase. Let me ask you to just consider this. How many times have you had information which turned out, in hindsight, to pan out very profitably over a 3 to 6 month period, but you failed to use it effectively? Just think about that for a minute, and if you're partway honest, you'd, I think, acknowledge that it happens from time to time. And if you're totally honest, you'll probably acknowledge that it happens a lot of the time, because it's just the way that we tend to react to situations in the market. So when this webinar is finished, I'd really like you to just stop and consider that question, and maybe write that question down now so that you can just give it some thought later on. Because most times the payoff from having a piece of information such as I'm giving you tonight, most times the payoff doesn't happen instantly. Most times the payoff is delayed, and quite often the price of a share can go down before it goes up, and that's despite the fundamentals being terrific, the value being terrific, the price can still go down. So really, really important question to contemplate. Now, with a stock like Gilead as an example, we got a pretty good idea where the trend is going medium term if we've done our homework. We just don't know about what the price is going to do in the short term. That's the issue. And anyone that thinks they know where the price will go in the short term is absolutely kidding themselves, because, as we've seen in the last week, markets are capable of anything out of the blue if there's a trigger. And a lot of people are saying that, the US market has corrected because it was overvalued. Now, there's a few stocks that are overvalued, but that statement is just, in my view, is just incorrect. The American stock market, given their circumstances at the moment, in my view, is not overvalued as a general statement. And it's certainly possible to find some great value. Now, these are the conditions of this setup that I'm going to go through and show you and give you some examples. The first thing you look for is what I call a strong phase 2 uptrend. Now, I don't have time to really deal with phase analysis tonight. Again, it's not the focus of the webinar. There are plenty of blogs and videos on our website that talk about phase analysis if you want to understand that a little bit better. But what we're looking for is a strong uptrend. We're looking for the price, whether it be of a stock or of an index, to remain well above the 150-day moving average through the majority of that uptrend. The dips, as they come along, are shallow and brief. They generally only last a handful of days or a few weeks at most. So that's indicating real strength in the trend. The second thing we look at are the criteria around the entry. So I'm looking for a reversal confirmation on the RSI, which is a momentum indicator, from below 40 and preferably below 30. Now, in setting these criteria, again, it's not a matter of you've got to tick every box for this to be valid. I'm not a completely mechanical trader. I don't go around and if every box gets ticked, then I just take the trade. Everything has to be in context, and I like to see most of these things met, but certainly not all of them have to be met if there's a compelling case otherwise. So we're looking for a reversal on the RSI. So we've got to a position of being oversold. Now, ideally, if your trading size is big enough, ideally buy in 2 tranches, because if you buy one lot and then the price goes down a bit, well, you get an opportunity to buy the second lot and average your price down. The next thing is to set the stop loss below the recent low. So that's part of the risk management process. And if this doesn't work out and the market doesn't play ball with the fundamental analysis and the overall uptrend and whatever things happen, then don't write the stock off. Your research could be quite valid. Your valuation could be quite valid. Don't write the stock off. Be prepared, if you get the right setup and the right signal again, to come back in and have a second go at it if you get stopped out. So let's have a look at some examples. I want to look at Apple, which is the biggest business in the world. I want to look at a semiconductor stock called Skyworks. I want to look at an Australian company that's probably just about the best trend that I can find in Australia, and it's also a terrific financial performer. Gilead Sciences, we've already really looked at that price chart. And also I want to have a look at NXP Semiconductors. Now, they got absolutely smashed on Friday night. But again, that doesn't invalidate the information that I'm giving you tonight. In fact, in a way, it reinforces it. So I think I want to look at that one as well. All great trends finish at some stage, so I'm also going to cover what to look out for as well. So let's jump in and have a look at Apple. Now, we'll pan back. Apple on a adjusted basis, because they did a 7-for-1 stock split a little while ago, got to a peak of $100 in 2012. There were some concerns after Steve Jobs died that Apple was going ex-growth, and the price got down to 55, so it lost almost half its value. Pretty inexplicable, really. It then went into a significant uptrend, which really started, the breakout really started about August of last year. So this uptrend in Apple started about 12 months ago. And as you can see, has been a pretty powerful uptrend and has propelled the stock from around mid-60s up to about $105. You'll notice that over the latter stages of that uptrend, that the price is now well above the moving average. The moving average, which is the red line, that's a 150-day moving average, is heading up at quite a robust rate, and the price is well above it. So that is indicating real strength in the trend. The other aspect, of course, to note is that despite the huge upheaval on Thursday and Friday night, the price of Apple was virtually unchanged. That's a really good sign. Now, you'll notice there's a couple of green boxes here. A good opportunity to buy Apple was when it pulled back to the 150-day moving average. The RSI down here got to below 40 and turned up. So that was buying around about 71. So you actually got a second opportunity to buy the stock around 70. So that was in January of this year. So from January, the price has gone up by 50%. When you can make 50% out of the world's biggest stock that remains cheap and has got a good growth profile, then I reckon that's a pretty low risk, high rewarding kind of situation to get yourself into. You'll notice that there's a shorter term uptrend at this stage which still hasn't been broken. So there's one example with Apple. Let's look at Skyworks. Now, all the semiconductor stocks got absolutely smacked on Friday night because of a report by Goldman Sachs. Now, to my mind, there is absolutely no substance to that report as far as it affects the companies that I deal in. And the reporting season, which is just starting now, I expect will demonstrate what I'm saying. Now, you'll notice with Skyworks, it started its move around $26 in November last year, so a little bit under a year. It's gone from $26 to $60. So a more than 100% increase. You'll notice the 150-day moving average has been in very, very strong uptrend. So is the price. And it's just in the last few days that the price has come back. In fact, on Friday night, came back to the moving average. Now, given what's going on around the world, and this gets back to the issue I keep making about putting things into global context, we don't know how this market is going to play out in Europe over the next few days or the next few weeks. I think it's prudent to let's see some substance from the American reporting season before we start wading into the market purely in isolation and say, well, okay, we tick that box and we tick this box, therefore it's time to buy. Things are